Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us discuss now the concept of operating ratio, which is one of the important revenue statement ratio used by the managers to understand the productivity cost control of business. How operating ratio to be calculated, what is its significance, that we are going to understand now. Operating ratio, meaning operating ratio expresses the relationship between total operating cost and net sales. It is expressed by way of percentage. Formula: operating ratio, cost of goods sold plus operating expenses divided by net sales multiplied by 100. Components: cost of goods sold, operating expenses, office and administration expenses, selling and distribution expenses, finance expenses excluding interest on loans and debentures. Net sales. Net sales means gross sales minus returns. One note we are required to focus here: finance expenses will include only discount, bad debts, etc. Interest on term loans. Interest on term loans on debenture is financing cost and not a operating expenditure based on accounting standard. However, some authorities treat interest on bank overdraft or a temporary loan as operating expense because it is treated as current liabilities and not a loan. Functions and purpose. Operating ratio indicates cost of operations. Its purpose is to measure and ascertain the efficiency of management as regard to operations. This ratio helps to judge how efficiently concern is controlling its cost of production, purchase, labor, administration, selling, inventory, and how much amount of sales revenue is used up in carrying out the operations of the concerns. Actual ratio, interpretation and comments. Actual ratio, actual operating ratio of X% indicates that each sale of rupees 100, operating cost of rupees X are incurred and an amount of rupees 100 minus X is available for meeting non-operating expenses. For example, operating ratio of 60% indicates that on each sale of rupees 100, the operating cost rupees 60 are incurred and 40 rupees are available for meeting the non-operating expenses. Actual ratio close to standard. There is no standard operating ratio in absolute terms. Each concern has to determine its own standard ratio based on its own past ratios, ratios of other concern in same industry, and the average for entire industry. An operating ratio close to such company standard shows a good control over the cost of operations, that is over the operations of purchase, production, labor, administration, sales and inventory. Optimum margin available to meet non-operating expenses. What if operating ratio is higher than the standard? An operating ratio higher than the standard shows low efficiency in managing the operation of concern. Example: purchases made at high price, low level of production, too high or too low level of stocks, higher direct cost of labor, fuel and freight, etc. A low margin available to meet non-operating expenses. Actual ratio lower than the standard indicates high efficiency in managing the operation of the concern, like purchases are made at low prices, optimum level of production, good inventory management, good control on direct cost, fuel, etc. A very good margin available to meet non-operating expenses. Interaction with the other ratios. Operating ratio shows total of all costs in all areas such as administration, sales, etc. It is advisable to break up its various expenses ratios so that we can know which expenditure in particular is increasing disproportionately. Operating ratio should be always studied with expense ratio and operating net profit ratio before commenting on profitability of the concern. Calculate operating ratio from the following information. We have information of sales 10 lakhs, gross profit 4,50,000 and operating expenses 2 lakhs. Operating ratio is equal to cost of goods sold plus operating expenses divided by net sales multiplied by 100. Here we have information of sales 10 lakhs, gross profit 4 lakh 50,000. Sales minus gross profit 10 lakh minus 4 lakh 50,000, we get cost of goods sold 5 lakh 50,000. In this formula we'll require cost of goods sold 5 lakh 50,000 plus operating expenses. We have operating expenses here 2 lakhs divided by net sales 10 lakhs multiplied by 100. So your operating ratio is 75%. We can see one more example on operating ratio. From the following information, calculate the operating ratio. Opening stock, this will be part of cost of goods sold. Purchases, part of cost of goods sold. Direct expenses, part of cost of goods sold. Closing stock, this will be deducted while calculating cost of goods sold. Administration expenses, selling expenses, sales. We have calculated cost of goods sold, opening stock plus purchases plus direct expenses minus closing stock. We got the figure of cost of goods sold. Operating ratio is equal to cost of goods sold plus operating expenses, that is administration expenses and selling expenses divided by net sales multiplied by 100. Cost of goods sold we have 3 lakhs, administration 90,000, selling 10,000. Sales is given rupees 5 lakhs. So we got operating ratio 80%. In this video, we have understood meaning of operating ratio, how it can be calculated, its significance, components. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.